Good afternoon, fellow investors. My name is Darin Davis and my business partner,
Tom Burns.
We want to thank you guys for stepping in and spending a few minutes with us to go through part of our educational series. A lot of you may remember we used to have a in-office program that we did every quarter called Good, Better, Best. And Tom and I's background has always been education first. And that's really how we met and got started in the investment world as we started going to investment conferences and just learning. It was really exciting for us when we started doing the Good, Better, Best program, but then COVID hit and we had to put it on pause for a little bit until we actually understood how valuable the virtual world really is. So going forward, and we got a tremendous amount of good feedback on this, hey, we like the virtual, we can see it anytime we want to. So if you guys will record it and get it out there, we're all in. So, with that said, we're going to go ahead and start. And today's program or today's educational series is really based on the question, one of the questions we get all the time. Why do you guys do development? Why aren't you doing acquisition? And I can't say there's a better solution or a better answer for development versus acquisition, but timing is a lot of it. And we're going to spend a few minutes going through that today and telling you why we've spent so much time the last couple of years going to development. And I foresee that going forward for the next few years.
Yeah, not much to add, except we will still have some live events. The virtual ones are great. They don't come with free drinks. So hopefully we'll get together sometime in the future.
We will by the end of this calendar year, for sure. Let's get started. Most of you would know that have invested with us in the past, we were really focused on Texas. We've looked in other states, but Texas just continues to provide us opportunities that are really hard for us to pass. Plus, we're based here. We've both grown up here. Our network is here. And not to say that we wouldn't go to other states. We've looked in Colorado and Utah and Florida and the Carolinas, all great opportunities out there, but Texas is our home. And if you look at our current portfolio, you can see everything from North Texas all the way through the I-35 corridor, coming down to Austin, San Antonio. And we just got our first project in Houston about 6 months ago. This is our current portfolio. And I'll start with the top left. You'll see the retreat at North Bluff. That was the first one that Tom and I did together. And honestly, we didn't have a lot of experience in development, but we had some great partners. And our partners taught us, hey guys, here's how you do it. Here's what you do. And from then on, I think bottom line, we were kind of hooked. We saw the value of development. We saw the opportunity. If you go all the way to the bottom right, you'll see the Cavalry at Liberty Hill. That's an actual project that we have, I think is funded already, but that's the last one. But what you're seeing is there's projects that are all through the cycle. So anything from we still own it and we're cash flowing it to the next one to the right is the current and New Braunfels. That one is under contract. And then somewhere in between all of those and kicking off the Cavalry at Liberty Hill, we're in that process. And so I think this is a pretty fair representation of what we do. Central Texas, Class A development, 8 projects at a time, 9 projects at a time. And that's what you'll see in our pipeline going forward. Now, why multifamily? It was pretty obvious to us. I think Tom and I both did a lot of different things, from mobile home parks to cell towers to spec homes to retail centers to condo conversions. But what we ended up really looking at and what we felt the most comfortable with after trying multiple things for over a decade personally, we did them all personally. It wasn't with a business. We just saw that multifamily was providing, historically higher returns in all of those. We like that hard asset of it. And then I know Tom's going to talk a little bit about the tax advantages as we get into this, but we're going to go through these and actually spend a few minutes and saying kind of why we did what we did to go into the multifamily business. Tom, why don't you pick it up here?
Yeah, back when we made that decision, we had expertise in some other things, and we just thought that multifamily built or bought right was going to weather what might be the next recession or down times. And it just performed so well in good times. And obviously the last 10 or 12 years has really proven that. So if you look at data, if you look at this graph here, the bottom line is the S&P 500. That's if you'd invested $100,000 back in the year 2000. Pre-2001, pre-2008, and pre-massive growth that we've had the last 10 years. So your $100,000 would have gone to 356. Not bad at all. Had you put your money in a REIT, now I'll qualify this, we are not a real estate investment trust. We're private real estate, so a little bit different returns. We think better returns with what we do, but this is a REIT and your return would have been better. Not huge, $64,000 higher than you would have had if you'd just invested in the S&P, but somewhat higher than if you'd have put your money in the equities market. I think Darin's going to try to put that in perspective for us on the next slide.
Sure, absolutely. So really, and people like to look at graphs and bars, and I just want to put that into a bar graph for you here. Again, 356 to 420, not the end of the world when you think that's a 20-year period. But as we go through this educational series and show you some more data, I think you'll see the importance of why real estate should be a part of your portfolio. And it's why we did it for us as well.
Absolutely.
I mean, we did it personally and it just turned into a business.
Right.
That's kind of a good thing. That's how most entrepreneurs start, right?
We don't like to pay taxes and we like to make money.
Yeah. That's good. So this one I think is really, really important. And I think this one even caught Tom and I by surprise. When we were doing our research, kind of going, risk and reward and cost benefit analysis, and why do we do what we do? And why have we chosen to go into development? Well, if you look over the last 100 years, Forbes, who has been tracking this information, produced it. So if you look at real estate as a whole, compared to paper stocks, the S&P 500, NASDAQ, the stock market, if you look to the left over on volatility, you see that stocks have almost a 2x volatility ranking than real estate. If you look over to the right, real estate and stocks over this 100-year period have about the same return. So if you look at the graph Tom and I presented just before and saw that we actually made a little bit better money in a real estate transaction than we did the S&P, but if you pop in the volatility, are you willing to take that 2x risk over a long period of time? I mean, because if you don't time it right, it can be very bad. So
it's a risk and return equation, and you can also throw in the control factor. Real estate, you have some degree of control over your real estate. You can lower rents to keep your property full. You can upgrade it with improvements. There's not a whole lot of control, at least in my mind, in the equities market. So you can add a little bit of control to this graph too.
So, all right, what do we like and why? It's hard assets, and there's all different types of hard assets, but the one we chose,
real estate.
Yeah, man, you can see there's a multifamily picture. How about that?
And I tell you, if you think these days, a lot of really big funds, one recently that Darin and I talked to, they, with the problems going on over in Eastern Europe and inflation, they are seeking out hard assets. That's a quote from the people that talk to us. So those with the big money are looking for hard assets. They're not going to go away. They're not without their problems, but having a hard asset is going to be there for you in the future. They tend to weather the ups and downs of the markets a little better than the volatility of a paper asset.
Yeah, good, well said. So why don't you talk a little bit about one of the other things we really liked was what tax advantages we get by being in real estate.
Yeah, I'm a good citizen, but I hate to pay taxes. I'll pay them when I have to. But you know what? The United States is a tax haven, as are a lot of other countries, if you really think about it. These governments want to give you incentives to do what they want to run their societies. So in the real estate world, we must have housing. We have to have places to run our businesses. So the government gives us benefits. In real estate, we often pay long-term capital gains when we sell something that's lower than the ordinary tax rate, about half right now. Depreciation is one of those gifts from the government. That's a phantom loss that you're able to use every year to offset income that you've gained. So in essence, if things go as they're supposed to, if they go right, you don't pay tax on the income you get from your real estate. Cost segregation studies accelerate that process and really give you losses that you can use to carry forward for years to come, or you can offset other income. 1031 exchange has been around for a long time. Another tax saving vehicle in the real estate world. You can buy something, it may appreciate over 20 years. That's a lot of appreciation, a lot of long-term capital gains that you'll pay. But there's a mechanism for you to trade that out into another property. Again, defer your taxes. So the idea is to possibly defer your taxes until maybe you pass away. Opportunity zones, a bit newer, but a way to take money from any type of capital gain you've had, including out of the equities market, put it into real estate or business, and again, defer taxes. So the government, these are not loopholes. This is just the government getting you to do what they want. They are getting their money and they're allowing you to participate in that profit. So that's why we love real estate. You can, done right, you can pay very little to no taxes if it's done just right.
Well, and developing real estate is not easy. And so the government's looking for ways to say, how do we help these guys? We need housing, and if we can help developers to provide housing, it's not something what the government taking on. Public housing at the government level, we know has failed time and time again.
They're not good landlords.
No,
nor are they good business people.
Yeah, but they do give us the opportunity to defer taxes and to, in some cases, actually remove them completely. Right. So this is not rocket science, you guys, and these are basic business practices, but we do want to spend a little time on it and kind of tell you kind of why we're doing what we're doing, where we're doing it. But the simple things are, it's supply and demand. And when I talk about location, it's really where the jobs are. It's all about jobs. It's all about growth. It's all about business. And then we'll spend a little bit of time on why we actually have chosen to do development, and probably will so for the foreseeable future. So let's talk a little bit about Texas. And the growth. This graph, or this chart, I should say, is from 2019, and we have in the highlighted area, we show Texas and we see the growth. Over to the far right, what I think is important to understand, if you look at Texas over that 20-year period, you saw that we led the nation in population growth. This is pre-COVID, all right? Since COVID, we don't have actual current numbers, but what we do have is some projections at Texas A&M and our the real estate group down there said that in 2021, the population for Texas would be 29.5 million people. They're right on target. In fact, they were a little under, but they're projecting that to be 54 million by 2050, which we will lead the nation neck and neck with Florida for the demographers who projected we're going to look to grow. So between Texas and Florida, those are going to be the two states that just have the most growth. Now, why is that? Well, it's a business climate, okay? But we'll get into the business climate, but here is something I want to point out. If you look at all these states, all these cities, they're in the Texas, Florida, Sunbelt market, right? Okay. You look to the bar left on the blue bar chart on the left, you see the actual supply that was brought to the city. We'll see Orlando, Charlotte, Austin. And then if you look to the right, you can see the demand. So we can't build them, or developers can't build apartments fast enough to meet the demand. Right. The supply is just going to be lower, and that is going to be probably true for the next 5 or 10 years in the Sunbelt states. I think one thing I want to point out here, from one of our peers, just published an article that was saying rent growth. Okay, rent growth nationwide, which includes the Sunbelt states, everybody. Was right at 13% year over year for rent growth. If you go to Miami, which is on one end of the spectrum, it was 40%. Austin, where we are, 21%, which is just phenomenal numbers when you think about what we typically underwrite at, 2.5%, 3.5% per year rent growth. We don't expect to see those numbers, but at 20, 30, 40, but we sure expect them to see higher than 2, 3, and 4.
Yeah, those are crazy numbers, and they'll certainly come down, but it's just evidence that the country is sagging into the Sun Belt. We're not seeing those kind of growth numbers in Champaign, Illinois, right? Detroit's not growing at a breakneck pace. I'm sure they're great places, but most of the country wants to live in the South. And as you can see, we can't build them fast enough, and there's only so many on the ground now. So we think we've got some runway for a while.
We do. So let's talk a little bit about the location. And really, guys, what we're talking about here is Texas. The Dallas-Fort Worth Metro, the Austin Metro, the San Antonio Metro, the Houston Metro. I mean, these are massive cities. If you look at 3 of those 4 are in the top 10, for the state of Texas. So, the Houston DFW and San Antonio Metros. I mean,
and Austin's number 11.
Yeah. Yeah. We'll get there maybe a few years. But and the other thing I want to point out is that we're number 2 in the nation in our economy, only to California, but we're number 5 in the world. So when you look at, I mean, number 5 in the world and growing, and we're gonna probably pass California, not anytime soon. They're pretty massive, but we're gonna be there in the next few years. We just continue to grow. I mean, the business climate here with the way we're taxed minimally, I should say, overall, the amount of jobs that are coming here, it's just a very, very great business environment for companies to move here, which I'll let you talk a little bit about some of these companies you're relocating to Texas.
Yeah, it's a really business friendly state. And Darin and I have a really good friend who about 25 years ago, they went off to Korea and Japan and China and talked to companies, tried to get them to bring some of their business here. Well, if you look at this slide, you can see they were reasonably successful. We've got some of the titans of industry, a lot of tech companies here. And these folks, you can feel it. Living here in Austin, those of you that live here in Austin, you can feel it. You know, the Elon Musk effect with Tesla, there are a lot of businesses coming here. It's not just people that work at the Tesla factory or work for Amazon or Facebook or Meta, whatever it's called. It's all the supporting businesses that come along with them. And so all these folks, they need a place to live. They want a nice little home to rent in a built to rent community, or they want an apartment, or maybe they'll go buy a house. But it's quite an environment. And that's also why a lot of the big money is coming to Austin. You know, over in Dubai, they know about Austin. So a lot of the money wants to come here. The reason for that is that although it's not that they don't expect some sort of fluctuations in the market, they just know if and when it does fluctuate, Austin, Texas and Central Texas will probably fluctuate less as it did in the 2008 recession. We tend to come into recession last, we don't go as deep, and we come out faster. So they're protecting their principal and they're bringing their headquarters here. So we love it.
Yeah. You know, we have, 50 of the Fortune 500. I mean, that's 10%.
Yeah, it's
that are in the state of Texas that are here. So let's talk a little bit about development. I wanted to put this slide up first because I like to go visual, and then we'll break it down. And what I want to point out here is the comparison of a local comp that just traded 2 months ago in our market where we're actually developing a property. And what I want to point out to everybody is people always say, oh, development's risky. And I'm going, well, no, it's not if you understand what you're doing. Right. And I was saying, well, how do I show this visually in a graph? Well, let's look to the left side. At the bottom of that bar chart there, you see acquisition comp. Well, there is a comp that's less than 5 miles of property, also a comparison, less than 5 miles from an asset that we're building called the Cavalry at Liberty Hill, and that's on the right. And I'll explain this in a second, but that complex or that apartment complex just traded for $270,000 a door. Okay, so they bought an existing property for $270,000, and I said, okay, that's pretty pricey, but the market's demanding that. If you look over to the right, we will be breaking ground on this asset in 3 to 4 weeks. And it's the Cavalry at Liberty Hill. We're going to be all in at $190,000 a door. So if you look at the value creation that we have provided to our investors, we're saying $80,000 that we're going to be creating day one, just based off that comp. Right now, this is incredibly important because if you're the investor that invested in the 270, and that one's probably going to get 2, 3%, 4% cash flow. Or you're the investor that invested in the 190 and you don't get any cash flow for 3 years, but you get a lot of cash in year 4. Right. What would you have chose at the time?
Right.
So
looking at your investment or how much cash flow you get.
Yep.
So there's a trade-off, but I think the net at the end, we think the value created off the starting blocks here is pretty significant. And it brings to mind, we've always said, look, development's not the answer to everything. There's always plenty of ways, plenty of things to invest in. Acquisition is great. This is development's just different than acquisition. It's been another option. Right now, and I don't know how long this will last, but right now, the metrics are really sort of favoring development because a lot of the currently built properties that are available for acquisition are trading at or above replacement cost. And of course, we build them at replacement cost for sure. So it's a metric to kind of really keep in mind right now, because that 270 a unit is tremendous, and that's a 2-3-year-old property.
Yeah, so about 3 years. Let's look at the metrics behind that, because then I want to come back to this slide and point something out. So if you did a comparison, so we can show you guys this is really a comparison that's real. This project is, less than 5 miles from us. If you look at that top bar, and then you can see the cost basis again, 270 for the acquisition, 190 for the development. Unit sizes are about the same, year built. 2018 is still considered a Class A project. We looked at their amenities, Class A. We're going to have some that is significantly nicer. So we put A+ on there. We're both considered a garden style apartment, 3-story walk up, surface parking. We're going to be in more of a walkable area with a movie theater, a grocery store, 6 or 7 restaurants, a bunch of services that are all around the property. And then again, I come back to the amenities. They kind of have standard Class A amenities. Not that a dog park and co-work is the end all, but there are some other amenities that this project's going to have.
We have a podcast studio.
Yes, we have a podcast studio. You know what? We came up with that. I don't know if we thought of it or somebody told us, but I was pretty impressed when we decided to put a podcast studio in there. But I want to go back to something here real quick. I want to point out, and Tom made me think of this, acquisition versus development. No doubt, 5 years from now, both of these assets at a fairly conservative valuation will be north of 300, probably per door. Okay. So I'm not saying your 270 is a bad investment. I'm just saying your 270 is a little bit different. You're still going to do really well on that project. You're going to get a great return. You're going to get your cash flow for 4 or 5 years, and then you're going to sell. On ours, you won't see any cash flow for the first 3. You will maybe year 4, and then we're selling in year 5.
Right.
Yeah. So they're both good investments. We've just created a little bit more buffer, I think, in the event that there is a downturn in the market.
Yeah.
From our basis being 270 and 190.
We've got room, and that's really important. You make your money on the buy or the build, I guess, to change that quote.
Yeah. So let's keep going here. So Tom, let's get into some real case studies, things that we've actually done.
Yeah,
okay?
you bet.
So the first one on the left is the very first asset we ever did, multifamily. We did a retreat in North Bluff. We still have that today, and that one has been cash flowing for us. At the time, we didn't have development experience, but we had a great partner in our development partner. We had a great general contractor. We learned quite a bit, and it's been a great asset for our investors and us. So we still have that one today. We'll probably put that one on the market here soon. Yeah. It's time for a new owner, but as of today, we have that. The other two are our 2 most recent sales, and the first one in the middle, Exeter Place in San Antonio. This one we actually sold pre-stabilized, and what that means is that we weren't at 95% occupied. We've been running with that occupancy rate for 6, 8, 12 months. But we actually had a buyer that was comfortable buying that asset pre-stabilized. And at the time, we're running kind of that COVID weird window. Mm-hmm. And we said, you know what, let's take some money off the table. We got a great return on it, and let's put that into new investment. So if you look at the numbers on there, we had it less than 3 years, had an 18 IRR. And a multiple of 1.5, which are very, very respectable numbers in any market.
Absolutely.
And then the one on the right, the stand at Lockhart, for you guys who don't know where Lockhart is, that's in the Austin MSA in the southeast part of Austin. Interesting about this one, we weren't sure about Lockhart. It was kind of out of cornfield. However, they had built a new highway, Interstate 130, and we knew growth was there. We just didn't know, was it coming in 2 years, 4 years, 6 years? And we didn't do a very large project. We had some additional land if we wanted to go to phase 2 on that. But if you look at the numbers on that, we had that, 3.5 years, we had a 26% IRR and a 2.25 multiple. So somebody that put in 100 grand got 225 back. Yeah, got 225 back.
One unique thing I always like to tell about this property is a thing we didn't know that was going to happen. As we're putting up the concrete and the sticks, we got an announcement from Elon Musk that he was going to build $1 billion truck factory 20 minutes north of this complex. So you never know. That's going to bring a lot of jobs. And so that's probably what helped us with the value. And it's really now sitting in an excellent location.
Yeah. And that Lockhart area is continuing to grow. And we're probably not done with Lockhart.
We may be in Lockhart again. Stay tuned.
Yeah. Oh. So let me give you an example of what an investment looks like on a development. And we just used $100,000 here. If you look to the top where we say year 1, of course, you make your $100,000 investment and there's no cash distribution. So, you're putting your money in, we're going through construction. Year 2, We start completing the construction probably 6, 7, 8 months into year 2. The back half of year 2, we start leasing the property and start generating some cash. Not enough to really make any significant difference to anything other than we're building up our cash basis. Year 3, we start looking at stabilizing that asset, which I mentioned earlier, understanding what the rents look like, so that we can actually take it to market. So what you would probably see is maybe some small cash flow in year 3, but a disposition, a sale sometime between month 36 and month 42. Now it's not out of the world that we would maybe refinance this project and go into long-term debt. That's an exit strategy. Right now, I will tell you this, we are selling everything we can, and here's a big reason why. As we underwrote all these assets 2, 3, 4 years ago, we are getting prices for these that were on our 7, 8, 9, 10-year pro forma. And so we're going like, we need to strike while the iron's hot. So, all of these we looked at potentially holding, long term. We're not opposed to cash flow at all.
They had debt on them that were designed for long-term holds.
Yeah. So if you look at the bottom, and I think this is the most important thing. People ask me, what are your returns? I get some people ask for IRR. I get some people ask for cash on cash. I get all kind of things. The one metric that I think is the most easy to understand and how we like to relate it to our investors is you have a multiple. You put 100 in, we have a 1.7 multiple, you get your 100 plus $70,000 of profit. And that's what this project at Calvary at Liberty Hill is projecting going forward. And we're pretty confident in the numbers that we have here. So if you look at Q2 of 22, we have 2 projects. It'll be a total about $88 million. So probably, equity is going to be probably somewhere around 20 million on that. Yeah. You can see Q3 pretty comfortable in that one. We'll have our second project in Houston and one more in a smaller, in a suburb of Austin. And then you see Q4 of this year and Q1 of 23. Those are shoring up to look like we're going to have some big numbers at the end of the year and really good start for Q1 of 23.
Yeah, things have really come together, and we think there's runway. Can't predict the future, but all numbers, all data just points to multifamily still being a great asset, at least for the foreseeable future, and Texas and Florida multifamily even looking stronger.
Yeah. And one thing I want to point out, if we don't have anything today, or if you're not ready today, or you're interested, please reach out to Robin Massey. We're going to have an email at the end of this presentation and say, hey, I may be interested in something in Q3 of 2022. I may be interested in next year. Let us know, because these things do fill up pretty fast. And I think giving you as much of a heads up as possible helps us as well to manage expectations. Now, everybody has a top 10.
Yep.
Okay. Top something. All right. So top 10, this is Tom and I thinking after read, what we think. And there's some industry people think the same thing, but these are the 10 things that we think are just out there that we have to consider: our underwriting, our evaluation, our go forward strategy. Everything we look at, this is things we have to consider. And when we underwrite, we think about this. Yeah. We don't just gloss over any of this. So I'll start off with the first one. And I have a little different take on this today than I did 2 weeks ago.
Yeah.
I had predicted, based off of what I read probably 6 months ago, that we would see 5 interest rate hikes in 22 and 23. A month ago, I was hearing 7 to 9 coming out of the Fed. 2 days ago, I heard we may hold off, because of what's going on in Ukraine and Russia, what's going on with inflation. So I still think there's going to be interest rate increases, but I don't know that it's going to be, 4 of them at 25 basis points, 2 of them 25 basis points, but I still think we're going to have.
Yeah, something's going to change. It's hard to predict. It's hard to translate Fed speak, but we need to be prepared for it. We need to be prepared as if they're going to raise.
Yeah. COVID, we're not going to belabor that one. It's still going to be disruptive for a year or 2 or 3. I feel like we're coming on the tail end of this. I think we're normalizing, whatever that may be. But I think our industry, the communities, just everything is starting to feel more normal. And just COVID's going to be a part of our life going forward. And we've got to learn to live with it.
Inflation, as we as we record this for you, I'm sure most of you have been to the gas pumps in the last 3 or 4 days. It's amazing. Inflation's 7, 8, 9% now. I think 10% in a month or so. So it's there. We just haven't. It's not that this is something that's never happened before. It's just a lot of us haven't seen this. We've been in a low inflation environment for a long time. The one thing, so inflation's bad on one end because it costs you more to buy a loaf of bread. It costs you more to buy gas. On the other hand, inflation can be used to create wealth. The debt, when you fix your debt, you end up paying for that hard asset that you own with less and less expensive currency. So we keep that in mind. We think debt is an important part of your wealth portfolio, and that's what we do is we create debt, and debt creates wealth.
Yeah, we lock into 10, 30-year debt at 3.5%, 4.5%, and inflation keeps going. It can be home run. So.
It's what is it? Inflation mediated debt destruction or something it's called. I forget what it's called.
Appreciation. As I mentioned on our pro formas, we were seeing our assets really appreciate. I think it's still going to happen, but not at the rate we've experienced in the last 18 months. Maybe half that. And if it is, it's still a fantastic time to be a seller. Suburbs, they're still going to be the go-to market. We actually chose the suburbs.
We chose them a long time ago, before it was cool to move out of the cities, just because we didn't want to be in competition with the really big shops in the interior. And we were comfortable with the suburbs and 2 and 3 story garden style apartments. Now that's where everything's moving. And they think that there's always a they, right? But with the remote work that was accelerated with COVID, they do not believe that it's going to go back to the way it was before. It'll be a hybrid. So there will be people working frequently from their homes. And if they only have to go to work 2 or 3 days a week and they can work in their home 2 or 3 days a week, maybe they might want to go out where it's a bit less expensive, a bit nicer. And so the suburbs are going to be important, again, for the near future going forward.
Yep. So 6 through 10, business-friendly states, the Sun Belt states, they're still going to grow. Texas is going to happen. Florida's going to happen. The Carolinas, Georgia, it's not going to slow down for the foreseeable future.
And rent growth is going to continue. Not at these rates, and it'll slow down and go negative at some point, but not anytime. Not any of the data shows it's going to happen anytime soon. Until there's too much product out there, too much more product than demand. Rent growth is still going to be there because that's what drives it. When demand is higher than supply, rents go up. So we think it's going to continue at a reasonable rate.
Same thing in the Southwest, like we showed earlier.
Yeah.
It's going to do the same. One thing I want to point out on the ground up construction, we've never seen this much ground up construction in the last 40 years. The margins are better than they've been since they've been tracking it since 1971. So people saying, well, how do you account for inflation? It's supply chain and material cost and well, the rents, the demand, the lack of property, it's the supply demand model.
Right.
And again, for the foreseeable future, next 2 or 3 years, I think ground up construction is still going to be, far exceeding the acquisition model.
Yeah, it's been there for a long time. Nothing's without its problems. There's material costs that affect acquisitions. They affect construction. And as Darin always reminds you, it's your education that limits your risk. And so this is just kind of where our DNA has been formed, and we've got really good folks that can at least project to the best of their abilities, and we do what we can to build them, value engineer them as much as possible, and just a little bit of growth, and we've got a pretty good product and a pretty good profit delta.
Yeah, and finally, new construction in the suburbs. That's where we are. Yeah. That's exactly what we do. We are new construction in the secondary markets around a big MSA, 15 to 20 miles outside of the downtown area. That's what we've been doing for the last 5 years. And we're in the right place at the right time.
It's nice. And we can drive to our properties. Like that. So not to say we wouldn't go elsewhere. We got good people in some other states, but right now Texas has given us plenty of business and plenty of opportunities for you guys.
So we'll probably be here for a while.
Yeah.
So, all right. Well, we want to thank you guys very much. I hate that we don't have a Q&A on this, but please give either one of us a call. The information you see right now is info@presarioventures.com. That goes directly to Robin, our Director of Investor Relations. She can filter any questions to us, Tom is PresarioVentures.com. I'm Darin at PresarioVentures.com. Reach out to us. We'll answer the questions. Any closing words?
No, I just think it's going to be quite a year. I'm really having a good time. We're having fun. We're working hard, but we're having fun.
Yeah.
And we do look forward to seeing everybody in person at some point.
Good. Great. Well, hey, thank you very much, guys. Have a good day.
Take care.